Hi everyone. Today we are talking about a very famous saying in the stock market: sell in May and go away, or buy in May and pray. The idea is very simple. Investors believe that the stock market is bad or boring in the summer. They think you should sell everything in May, go on vacation, and come back in September or November. But is this actually smart? Or is it a trap that will cost you thousands of dollars? Today, I am going to show you 70 years of data to prove why this myth is very dangerous. And at the end of the video, I will show you my own portfolio and show you exactly how much I made this month and what strategy I am taking for my portfolio. But just because a saying is old doesn't mean it's wrong. If we look at the history of S&P 500 from 1950 to today, there is a stubborn pattern. The winter months, November to April, usually have much higher returns than the summer months from May to October. Let's look at this chart. This chart shows the performance of S&P 500 from 1950 to 2023. The top yellow line shows what happens if you only invested during the winter months from November to April. The bottom line shows the summer from May to October. Since 1950, the winter months did all the heavy lifting. The summer months barely moved at all. So on paper, it looks like the myth is true. If the summer is flat, why stay invested? Here is the problem. Even though the summer line looks flat, but it is still going up. It's just going slowly. If you sell every May, you are missing out on these small gains. But more importantly, you are making your life very complicated. To make sell in May work, you have to be right twice. You have to know exactly when to sell in May and exactly when to buy back in. If you wait until October but the market rallies in August, you lose. Okay, let's take a look at another graph from Yahoo Finance. From 1928 to 1941, from the Great Depression to the early part of the World War II, the stretch from May through August was actually the strongest part of the year, according to the Yahoo Finance data. From 1942 to 1959, all three chunks of the calendar, January through April, May through August, and September through December, were positive and fairly balanced. The slogan's best evidence came later. From 1960 through 1987, a period that included the inflation shocks of the 1970s, rate hikes, and the 1987 crash, the S&P 500's May through August return was barely positive, making the middle of the year look like dead money compared with the rest of the calendar. Since 1988, the market has changed again. Rise of 401ks, index funds, ETFs, and automatic retirement account investing helped reshape how money moves into stocks. And in this modern stretch, sell in May has looked much less compelling as all three periods have averaged positive returns. Let's take a look at another full calendar seasonality map that tells a similar story. This graph shows average return month by month from 1988 to 2025, and as you can see, May averaged a gain of about 1.2%, making it stronger than half of all the months in the year. In fact, August and September were the only months with negative average returns in that period. So if we look at recent track record from 2013 to 2025, out of 13 years, the S&P 500 index was down only once in the month of May, and that was in 2019 when stocks gained almost 30% in the whole year. Okay, now let's look at the real world results. I did not go away this May. I stayed 100% invested in my growth and dividend stocks. My total portfolio value is $260,000 and the profit is $61,000, around 30%, and time weighted return is 42%. And if you look at the dynamics of portfolio returns, in the last month alone in May, I made around $7,400. It's a gain of around 3%. If I had followed the same myth and sold everything on May 1st, I would have zero of that $7,000. I would be sitting on the cash watching the market go up without me. This is why time in the market is always better than the timing in the market. The sell in May is a real piece of history. but it is terrible advice for the long-term investor. It creates anxiety, costs you in gain taxes, and makes you miss out all the dividends. Also, given the AI chip stocks and everything AI touches skyrocketing, instead of saying sell in May, go away, we should be saying stay in May, let the AI lead the way. My strategy is simple. I buy in every month May, June, July, August, September. I let compounding do the work for me while I enjoy my summer without selling my stocks. If you want to see more updates on my $260,000 portfolio and how I manage my dividends journey as an expat, make sure to subscribe. Let me know in the comments, are you selling this May or are you buying the dip? I'll see you in the next video.